We're back with more from Joe Saluzzi of Themis Trading. Joe, markets look like, it looks like we're stabilizing a little bit here. Certainly, well, NASDAQ down about 1.25% at the moment, so not stability there. But it does seem as if these daily gyrations suggest that people really have no clue as to what's going on. How do you position yourself, though, for that?
Well, and that's the problem. You don't. I think a lot of people have this I need to go home flat mentality. You can't do that if you're a fund manager, obviously. You can't go home flat. But people are this whole risk on, risk off that's been going on forever. It's crazy. Markets aren't supposed to trade that way. We're not supposed to be worried about, are the banks in Europe going to refinance or are they going to be buying sovereign bonds? We're supposed to be looking at earnings of American companies as a U.S. equity trader. That's what I do, and finding values. But the problem is you can't find those values when everything's caught up in this crazy correlated mess, this one big giant ETF.
We touched on this earlier, the idea of algorithmic trading and a lot of these high-frequency trades. You also talked about a flash crash.
Right.
Is that what you're talking about specifically, that the way the trading is done today is actually adding to the volatility?
Yeah, well, it is. And it's funny because, not funny, but before the flash crash, 2 months before, I think I was on with Matt Miller and Carol, and I said, look, we see this happening. We see a big drop happening just because of the way the lack of liquidity is out there. We still see the same thing, although there's been some new regulations placed by the SEC, things like circuit breakers and limit up, down, and so on. The problem with the market is there's a thin shell of liquidity. The top of the market is very, very thin. Once you bust through that top of the liquidity, there's nothing underneath. There's a hollow core. So if there's things that could do with a data corruption, a news event, something that would get the books of the high-frequency traders off balance. They will then probably pull out because they need to manage risk. Bids would just disappear like they did on May 6th, and the market would start crashing. And here's the problem this time. It's going to happen faster. This last time it took about 15 minutes, and then we broke. This time it'll be quicker because circuit breakers will kick in. You can drop 10% in 5 minutes. It could happen. And then go back up again.
What sets that off, though? What's the catalyst?
It's an imbalance. It's a data corruption. The problem is they look at data. High-frequency traders, what they're all about, good data. They need to make sure the data's good. If it's corrupted, if there's a news event that comes out somewhere, there's a rumor, and all of a sudden books get imbalanced, then they're going to pull out. They're going to spread them wider. The spreads that you see now at a penny a share are going to be much, much wider. The liquidity top of the book is going to be much, much thinner. And then all of a sudden the algorithms, which are not bad. I mean, regular institutional traders use them, but then they tend to catch up, and you get into a feedback loop. Once you're in a feedback loop, it's pretty much a death spiral at that point, and that's what's going to happen again. And it will happen again.
Dramatically. Why do you say it will happen again? Because when does it happen?
I don't know when. I mean, it could be this year. It could be, we'll see. But there's no fix to the market. As much as the SEC, picture it as, we've had a wound in the market. What they did was they put a Band-Aid. We use this example all the time. Rather than treating the cut and treating the disease and trying to fix the market structure, they're just constantly putting on short-term fixes. Underneath that Band-Aid is a wound that is infected, and that is the U.S. equity market. It has changed from an auction-based model where dealers were involved and committing real capital to a model where people it's hyper-second trading and they just want to clip a penny or two and scalp some poor institutional guy who comes along, and, they don't even know it half the time when the algorithms are trading. They're getting picked off by the HFTs all day long. People need to pay attention more to their order flow. That's what we do, obviously, at our firm, is to help our clients trade their stocks. But if you go in there and you're putting in market orders and you're using algorithms that aren't necessarily in tune with the market, you're going to get hurt. And look, it's a multi-billion-dollar industry, high-frequency trading, right? Money comes from somewhere. It just doesn't come out of the blue.
And you're saying a flash crash is inevitable not because of what is happening on a macro level, right? Not because of events in Europe or events here in the U.S., but just the way the system itself, the infrastructure, is faulty.
That's right. The infrastructure changed over a decade of regulations that had either intended or unintended consequences. The SEC did things like Reg ATS, the order handling rules, the Reg NMS, which was the biggest one. That pretty much was the death of the New York Stock Exchange as we know it. All of these rules, and decimalization, we can't forget that, created the market that we have today. You don't have real capital commitment anymore. That's the problem. That's why there's a lack of IPOs. People wonder what happened to the IPOs. There's no dealers to support them anymore. They got run out of business because the spreads were too small. You need to bring back real capital, real common sense to the market. It's going to take regulation or some sort of genius from D.C. to stand up and say, hey, we've got a problem here. And until another flash crash happens, they won't pay attention. So unfortunately, you're going to need more pain before you can get something fixed.
All right, Joe. As if we didn't have enough to worry about. Now a flash crash is on the way. Thank you.
Great. Thanks,
we appreciate the insight and certainly very unique perspective into the trading industry itself. That was Joe Saluzzi of Themis Trading.